What's up, traders? So today I'm going to show you how you can retire with less than $200,000 by running the wheel strategy on one single stock. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market. And I have a wife and 6 kids and I pay for our entire lifestyle with the money that I make from trading options. Now, before we get started, I want to highlight one of the members of my community and also thank God for answering prayer so quickly. Now, every single day before I get started working, I make sure to drop down to my knees and say the Lord's Prayer. And once I've done that, I typically say a personal prayer as well. And typically I ask the Lord for more discipline. I pray for my family and my friends, and I ask that He guide them throughout their day and put a shield of protection around them. But for some reason yesterday morning, instead of saying my typical prayer, I just pray that He make me a blessing to others. And that's all I pray for. It was very short and sweet. I just asked Him to make me a blessing to others, and I wanted to be effective with helping other people. All right, so that was yesterday morning. Now, within my community, we often see members post how much they make every single day. And while there's plenty of members making a lot of money every single day, I really don't know how significant that is to them. You know, like if somebody's making an extra $1,000 per day, I don't know if that's life-changing money to them or it's just a few extra bucks. Because I do know that there's multiple individuals with 7-figure accounts in the community. You know, so if they're making an extra $1,000 per day, it may not seem very significant to them. And I don't know the significance of it unless they actually tell me. And so here I want to highlight Ramon. So typically Ramon posts how much he makes every single day. And yesterday he posted another green day, $809 for Big Money Ramon. And that's a little insider joke between him and I. He's just been making so much money that I told him that I'm going to nickname him Big Money Ramon. He said he's cool with that. He likes that. I said, okay, Big Money Ramon. But you see, he posted a screenshot of his account and I said, hey, Big Money Ramon strikes again. And then under that comment, he wrote, your alerts is changing my family's life. We can make my whole living from trading now. Making $800 a day is amazing. Like, you got to understand the significance of that message. I had just prayed that the Lord make me a blessing to others. And by the end of the day, someone told me that I have changed their family's life. And to that, God gets all the glory and all the praise. And to Ramon, I'm super proud of you, man. We're going to keep this marathon going. But let's get down to business, folks. Please like this video. It would help me out tremendously. And subscribe to the channel. Why not? And do remember that I am not a financial advisor and this is not financial advice. All trading comes with risks. I'm just showing you how I've built wealth over time. Now, for those new to options, let me quickly explain what the wheel strategy even is. However, if you are experienced with options, make sure you stay to the end because I'm going to show you a better way to go about it and the data points that you should be looking at prior to entering into any trade. Now, what we see here is the wheel strategy. So we start off with selling a put. And when you sell a put, you agree to buy shares of a company at a lower price than what it's trading for today. And for making that agreement, you get paid money up front, which is called the premium. All right, so we sell a put and we collect the premium. But if the stock price doesn't drop below our strike price, then we don't have to buy the shares and we can continue doing the step over and over and over again. But if the stock price does drop below our strike price, which is the price that we agreed to buy the shares at, then we will get assigned. So we'll go ahead and buy the shares. And once we do that, we can go ahead and sell covered calls. Now, a covered call is just you agreeing to sell a stock at a certain price. And typically you would select a price above the price that you paid for the shares. And then again, for doing so, we collect money, which is called the premium. Now, we can do this step over and over and over again, as long as the stock price doesn't rise above our strike price. All right. But if it does, then we are forced to sell the shares. So we'll sell the shares and that completes the wheel strategy. And then you can start doing it over and over again. And now you can see why they call it a wheel, because it's just a big old circle. But that is the wheel strategy in a nutshell. Now let's take a look at the first step, which is selling puts. Well, the objective of selling puts is to, one, generate income and or to buy the underlying stock at a cheaper price than what it's selling for today. So we sell puts because we want to make money, obviously. And then 2, we may possibly just want to buy shares of the company at a cheaper price. And selling puts is basically like selling insurance, but instead of for a house or a car or something of that nature, you're doing it for stocks. All right, so an example is, let's say somebody owns NVIDIA stock and NVIDIA stock is currently trading for $120. Well, what you could do is sell a put, let's say at $100. And you're basically saying to the buyer, hey, if NVIDIA stock were to drop below $100, I will buy 100 shares of the company from you per contract that I have. But for doing so, you have to pay me, let's say $200 up front, and this contract is good for 30 days. So when you sell that put, you receive that $200 up front right here, right now. And from here, 2 things can happen. If NVIDIA, which is currently at $120, stays above your $100 strike, then you just keep the premium you were paid and you go about your day and you can start selling puts over and over and over and over again. So that is scenario number 1. And then scenario number 2 is NVIDIA's stock price, which is currently at $120, drops below your $100 strike. Well, then you're forced to buy 100 shares of the company per contract. However, you still keep the premium you were paid Just like your car insurance company keeps the premium, you pay them every single month, whether you get into a car accident or you don't. So that is selling puts. Now, typically you would want to do this strategy on a company that you believe in the long term. And you would want to set your strike at prices that you're willing to buy the company at. More on that in a moment. Now let's talk about selling covered calls. All right, so the objective of covered calls is very similar to selling puts. Here we want to generate income and profit from a stock that we now own. So when you sell puts, you're agreeing to buy shares at a price, but when you sell covered calls, you are agreeing to sell shares at a certain price. And the reason it's called a covered call is because you already own the shares. So when you sell that call, it is covered by your shares. So with the previous example, let's say that Nvidia's price did drop below $100 and we were forced to buy the shares at the $100 strike. Well, now we can turn around and sell a covered call at any price above $100. And for doing so, we are agreeing to sell the shares at that price. Now, the great thing with covered calls is you can be as aggressive as you want. Because now that you own the shares at $100, you could turn around and sell a covered call at $100 if you want to, or you could pick any price above. But the closer to that $100 mark that you set, the more money you'll be paid from the contract. All right, but more on that in a moment. Now, if you're looking to retire, you're probably wanting to use these option strategies on a stock that is very dependable. You may not want to constantly look at financial statements. You probably don't want to worry about the results of an earnings release. So instead of running this strategy on an individual stock, what you could do is run this strategy on an ETF that follows the entire S&P 500. And one of the most popular S&P 500 ETFs is ticker symbol SPY. Now, if you have less than $200,000 in your account, using SPY may not be effective, and let me show you why. So here we can see that SPY is currently priced at $561. Now remember, when we're selling puts, we're agreeing to buy the shares of the stock at the strike price that we select. So if we were to sell puts at, let's say, $550, that would be $55,000 that we would have to pay per contract if SPY were to drop below our strike price. And at $55,000, we wouldn't even be able to do 4 contracts. And so because of SPY's huge stock price, I like to run the wheel strategy on ticker symbol UPRO. So here we can see UPRO is a leveraged ETF to the S&P 500. Now, what is a leveraged ETF? A leveraged ETF is simply an ETF that follows a specific stock or sector, and it looks to move typically around 2 to 3 times per that stock or sector every single day. All right, and we can see that this is a 3x leveraged ETF to the S&P 500. So UPRO looks to move 3 times the amount that the S&P 500 moves every single day. So on a day like today where the S&P 500 is down about 1%, you can see that UPRO is down 3% for the day. And the same would work in reverse. If the S&P 500 was up 1% for the day, then UPRO would be up about 3% for the day. And the reason I love trading UPRO as an options trader is one, because since it is more volatile, that means there is more premium. All right, the more a stock moves, the higher their premiums will be. And then 2, typically a leveraged ETF is at a lower stock price than whatever stock or sector that it's following. And you can see here that that is exactly the case for UPRO. So if we recall, ticker symbol SPY was trading around $560 something. Well, we can see UPRO is trading at $74. So that makes selling puts on it a whole lot easier because we don't have to dish out so much money when we're agreeing to buy the shares. And if we look here at the companies that are within UPRO, you can see that they are the same companies that are in the S&P 500. So we have all the big names: Apple, Nvidia, Microsoft, Amazon, Meta, Google, Berkshire, Broadcom. So just like ticker symbol SPY, it follows the S&P 500. It's just that UPRO is a 3x leveraged ETF to the S&P 500. But real quick, if you know anybody that you think could benefit from learning from me, please tell them about the Trade to Freedom community. Within this community, not only will they see my exact trades when I enter them, but they'll also get my entire options framework via the Trade to Freedom course. Thirdly, they'll have full access to me and ask me questions at any time. And then lastly, they'll be within a community of other traders that all have the exact same goals as them. So if you know anybody, please send them the link in the description below. We would love to have them as part of the community so we can help them make this year, 2025, their best year yet. But let's take a look at a few data points that I like to look at prior to placing any trade. All right, so here we have the chart for UPRO, and you can see that these black lines here, well, these are called the Bollinger Bands. And the Bollinger Band just aims to show you what range that a stock price is expected to trade within. And typically it's about 95% accurate. So you can see during normal times, it trades within and then it will pop out for a little bit. And then within a few days, it pops back in. It popped out here on the downside, it came right back in. And then this just keeps happening over and over and over again. So when it pops out of the Bollinger Band, it typically goes back in, usually within a few days. Now we can see during this big downturn, it did spend several days outside of the Bollinger Band, but you can see it kept trying to pop back in, and now we are definitely back in the Bollinger Band. But when selling puts, I like to see that the stock price is at the bottom range of the Bollinger Band, and that is what it currently is. So we can see at the low end, the Bollinger Band is at $71.04. And then on the top end, it is $88.99. And typically, the closer it is to the bottom of that Bollinger Band, the more aggressive I'm willing to be when it comes to selling puts. But that is the first data point that I look at. And then for the second data point, we are going to head on over to Thinkorswim. So now we're here at the options chain for UPRO. Now, typically, you want to select the expiration date that is within 45 days. Now, it doesn't have to be 45 days. It could be 35, 30, 25, 27. That doesn't matter. It's just if you want the time value to decay the fastest, you want to select a date that is within 45 days. Now with UPRO, because it doesn't have the huge amounts of volume that, let's say, a ticker symbol SPY would have, you typically want to go out to the monthly expirations because those expirations will always have more volume and open interest than the weekly expirations. So we can see here that the next monthly expiration, well, we have a monthly expiration coming up 3 days. However, because we're trying to get monthly income, let's go out to the next one, which is perfectly 30 days out from now. So we'll go ahead and select that. And the next data point that I want to look at is the expected move. And so if we come all the way to the right here, you can see that in parentheses, there's a plus minus $11.55. That is the expected move. Now I'm on Thinkorswim because I have Charles Schwab, and they specifically call it their market maker's move. However, it's very similar to the expected move. And so that is showing us that the options market currently has priced an $11.55 move, either up or down, within the next 30 days. All right, so if I am selling puts, I want to select a strike that is near or below that mark. So we can see that UPRO stock price is currently $74. So if we subtract $11 from that, that would get us at $63. So if I want to select a strike that is near or below that, I would probably go to the $65 or the $60 strike. So perfect, we have that data point. And then the last data point that I want to look at is the delta. Now, by definition, the delta will show you how much an options premium will move per a $1 move in the stock price. So at this strike of $70, which has a 0.32 delta, it is saying that the options premium, which you can see here, will move about 32 cents per a $1 move in UPRO stock price. Okay, but however, I and most successful traders that I know use the delta as kind of like a probability of an event occurring. And so I would look at this $70 strike, which is still at a delta of 32. And to me, that says there's about a 32% chance that UPRO's stock price will drop down to $70 by this expiration date. So in other words, I will have about a 68% probability of profit. And I personally like to stick to strikes of 0.20 or below. Now, when I was growing my account, I would use deltas of 0.30 or below because typically when you have a smaller account, you have to be a little bit more aggressive. But for the purposes of this video, if you're thinking about retirement, I'm assuming you have a few coins stacked up. So I want to go to a delta of around 0.20 or below. So the $65 strike is a delta of 0.21 and the $60 strike is a delta of 0.13. So which strike you choose is just depending on how aggressive you want to be right now. Now we can see that the $65 strike will pay anywhere between $1.90 and $2.05. Now, if you're new to options, every contract is worth 100 shares. So the amount that you see here is per share. So you'll always times it by 100 to see how much money you'll collect immediately. So if we were to sell a put at the $65 strike, we would make anywhere between $190 and $205 immediately right here, right now. And then for the $60 strike, we would make anywhere between $110 and $125 right here, right now. All right, so that's perfect, and we have that data. And another quick tip is to sell puts on red days. Now, we can see here that is definitely a red day. UPRO is down by 3.4%. And so these premiums are higher than what it would have been yesterday when UPRO was up. So just remember that when you sell puts on red days, you'll collect more premium. And then on the flip side, when you sell covered calls on green days, you will collect more premium. All right, so let's go ahead and place a trade. So let's assume that for today, we want to go with the $65 strike. So I can just come over here and select it, and it's already pre-filled everything for me. So we are selling, and then over here, we select the amount of contracts. Now, hear me out on this. You do not need to fill up your entire position all at one time. What I typically do about 90% of the time is I'll just do one contract for the day. And what this will allow you to do is as the S&P 500 moves up and down, you can select different strike prices. And you'll also be able to select different expiration dates as well. So it's kind of like dollar cost averaging in. And the reason it's better to do that and be more conservative is because, yes, if we go ahead and sell like 20 contracts right now and tomorrow's a big green day, then we make our money very quickly. However, as you've seen in the last month, the stock market has pretty much gone in a downward direction, which we are fine with selling puts and buying shares at those lower prices. It's just better if we select different strikes so we can kind of dollar cost average in. All right, so just remember that. One contract a day will keep the poverty away. So we can just keep that at one contract for now. Then everything else here is set. And then we'll just go ahead and select the mid price here at $1.92, $1.93. Now, just to show you the numbers and how much contracts you would need to have retirement income, at 25 contracts, we will be bringing in $4,792 per month. And if we go ahead and times that 25 contracts times the $6,500 per contract that we would need in case we were assigned, that puts us at $162,500. All right, so technically if you have $162,500, then you could bring in this $4,792 per month if you were to follow this exact trade at this specific time. However, please do not do this amount of contracts at one time. I know there's going to be somebody yapping their mouth in the comments. Oh, that's super dangerous. Listen, come closer. Listen, Linda, listen. I personally would keep it to one contract per day at max, and you can consistently build out your position over the course of the month. And it doesn't even need to be a contract per day. Maybe you do one contract on Monday, one contract on Wednesday, one contract on Friday. All right, but the point is spread it out just in case we get times like we had over the past month where the stock market just pretty much went in a downward direction the entire time. You can consistently select different prices. But let's fast forward out. Let's say we did all our put selling. Let's say we were assigned at certain strikes. All right, so that means we need to buy the shares of the company at the strike price that we selected. Now, here's where you can make even more money, because once you own the shares, you can be as aggressive with the strike price that you want. All right, so let's fast forward out. Let's assume that we had strikes of UPRO at $75 and we were assigned the shares. And now that we have the shares, we can go ahead and sell covered calls. Well, now since we were assigned the shares at $75, we can sell covered calls at anywhere at $75 or above. Okay, so I could come over here and sell covered calls at $75 and I would be paid anywhere between $480 and $500 per contract, which is an insane amount of money. And just out of curiosity, let's see how much that would be if we did the same amount of contracts. All right, 25 contracts times, let's say 490, which would be right in the middle there. Goodness, that would be $12,250 that you would receive over the next 30 days. Now, if you were to place that trade, what you are agreeing to is to sell the shares of UPRO at $75. So by expiration, if UPRO is above $75, then you'll be forced to sell your shares. However, you still keep that $12,250 of premium that you received. And if UPRO is below the $75 mark, then you still keep that $12,250 that you received. However, now you get to keep the shares as well. And you can continue running covered calls over and over and over and over again. But that would be a perfect scenario if we were to get assigned the shares at $75 and now it's currently at $74.77. So let's say that's not the scenario. Let's say that we were assigned the shares at $80. Okay, well, we could sell covered calls at now $80 and we'll still be paid anywhere between $245 to $265 per contract. And here's the beautiful thing about covered calls is you have the potential to make money in two separate ways, right? So of course you'll get the premium from the contract. However, you can also get the capital appreciation from the stock. So let's say if we were assigned the shares at $80 and then we sold a covered call at $85. Well, not only will we get the premium, which is currently between $100 and $110, but we'll also get the capital appreciation of that stock from the $80 that we purchased the shares at all the way up to $85, which would be $500 per contract if UPRO were to move up past $85 mark. All right, but that's how you could run the real strategy on UPRO to bring in some retirement income. Listen, I send blessings your way. I hope that God blesses you. I hope that you have the ability to retire at whatever age your heart desires. I'm wishing you nothing but increase all of 2025 and beyond. But that is it for this video. Please make sure you like the video, subscribe to the channel. And if you'd like to join the Trader Freedom community, the link is in the description below. But I will for sure see you guys in the next video. Peace!